Good morning, everybody. Thanks very much for joining us this morning. Really interesting to be back after the summer to get a kind of take on some of the kind of top issues, top sectors that we're looking at. And logistics, of course, has been a really hot topic over the past years, but has continued along with residential to be one of the areas that's really fascinating, I think, at the moment, and particularly good to just get a take on it, I think. As we move out of the summer and into the second half, really the second half of 2023, and also looking forward a little bit to 2024. For those of you on the live stream, of course, you've got the chat there on the right hand side of your screen. So please do use that. Any questions that you've got, please do pop those in, and we will make sure that we pick them up. Super panel here, and thanks very much to Garbe as well for organising, hosting this with us. We're going to hear from Marco Grassidonio, Managing Director, Country Head of Italy, shortly, and also Peter Bartholomäus as well, who's looking at the international fund side and more the capital markets side. But we're going to start off with Tobias Kassner, who's Head of Research, as well as a member of the Executive Board for Garbe Industrial Real Estate. And Tobias is just going to give, I guess, an overview of some of the research that they've been doing there at Garbe. I'm looking at the outlook for European logistics real estate. So over to you, Tobias.
Thank you very much, Richard, for the introduction. I'm happy to be part of the 6th presentation of our pyramid map and the webinar connected to it. Yes, thank you very much. For those of the attendees who are not familiar with Garbe, just a brief look out to our company slides. You all are getting the slides, so you don't need to take notes from here or the slides further on. Just to see why is it so important for ourselves to have such a deep knowledge about what is happening in the markets, because we are all across Europe since a few years, and we are happy that Marco Grassidonio from Italy is part of our webinar today. So he's talking about what's going on in Italy, of course. But since we are not only a developer, we are not only a portfolio management or fund manager, but also investor and a manager. We really need, you can see it here in our 360 degrees diagram, we really need to have a deep knowledge about the market dynamics. And therefore, we created a few years ago the pyramid map, because we weren't able to get facts and figures for all of the 130 sub-markets we're looking into when we talk about markets, thinking about investing, developing. So we really needed the data for our own, but we felt it is a very good thing for the industry itself, giving back the knowledge to have the transparency of the market. So this is all about the pyramid map connected. The yield and rent assessment map. If you have a question why we did it, label it pyramid map, you will be able to download it as a PDF file from the from our website. There's an interactive map as well. And yeah, by every half year, we are updating the facts and figures. So please subscribe to our newsletters as well if you want to find out what is happening next. But for the moment, with Expo Real in October, only a few weeks left until it starts. We think it's a very good thing to give us a common understanding about the market dynamics and to continue the talks, of course, at the Expo Real. Looking at the real estate climate, here it's only available for Germany, but it's, I think, more or less a situation in all of the European countries. As Richard said in the introduction, logistics is already a few years one of the most sought after investment classes when it comes to real estate. It already began way before the pandemic, but at the latest, they're connected with a supply chain disruption and the need for warehouses, and the e-commerce really spiked there. The industry was really one of the most sought after asset classes, connected with one of the steepest compression of the yields as well. And when we move on now to the Ukraine war last year and the spike in inflation, everything changes. You can see it here reflected in the figures. really dropping when it comes to the climate. And this is part, of course, part of the investment market and on the take-up side of the space market. Because one thing, the investment market, as we'll see in the next slides, is really changing because of the change in the interest rates. But it's still, together with the residential asset class, one of the most still working asset classes when it comes to residential, retail, or office. There's still structural changing facing ahead. This is not so much the situation for the logistics market, because the player really need space, and therefore the rental values are still increasing, what we see in the next slide. So here it's really the space take up beginning in the 2000s is really increasing from less than 1 million square meter a year to levels, record-breaking levels, to nearly or a little bit over 9 million square meters. Of course, this is changing as well. If you look to the figures for the first 2 quarters, this is part of the well, there's not much space left. There's not a very high vacancy, and not in our portfolio or the portfolios from other companies providing space. But it's together with somewhat, we see recession tendencies in some European countries, for example, in Germany. So it's connected with both of the reasons, but it's still working out, and it will increase in the near future when e-commerce kicks back in, and this is a relatively new forecast for the economic development, and the take-up is as you can see, really connected to it. So the demand for space will continue in our view. But as I said, the really big changes were last year. When it comes to the interest rates, we are showing here the rates for the European Central Bank. It's a little bit over 1 year ago that they started to increase the interest rates, together with the interest rates for long-term or short-term financing when it comes to developments or standing investments. And if we look into the future, there are signs that the interest rates will drop again. So the situation we are facing with on the investment market could change in the near future. It all depends on the fight, on the one hand, against the inflation, and on the other hand, the fight against recession or the down cycle of the economy, especially when we look, for example, to China, and not the really low dynamic on this market as well. So therefore, the policy from the ECB is to really look at the data, but the most current forecast on this matter is it looks promising that they could have a peak ahead, and with a downward trend in the near future, and then the investment market could kick back in as well. But at the moment, as you can see here, it's really here for in the first slide for Germany, but we have it for the Eurozone as well prepared. It's really something totally different than the way before, the years before. We had record-breaking transaction volumes with a share of 20 to 25% of the investment market in the Eurozone. So there was a really high demand connected with a big compression. But as you can see, when I change the map on the left side, the action which takes place where the transaction could be seen, the volume is way below 2 billion euros for the first half year. This is totally, it's a number we saw in 2014 last time, and it's all connected to the core parts of Germany. And moving to the Eurozone, it's more or less the same story we are facing here. It's more concentrated to the core markets in Benelux and in United Kingdom, and to the biggest logistics regions in each of the country. And in some countries we didn't see any transaction at all the first half year, so it's way less activity. And this is of course connected to the change in the interest rates. When it comes to the volume, you can see it here for each country. It's about 60 to 70% less transaction volume compared to the first half year in 2022. And in some countries, nearly 100%. Or we didn't have any transaction at all. So there's some that's blank space. For Scandinavia, it's only 60% as a aggregate, or for Spain, for example, it's only 27% less transaction volume. So it's really not the same picture for every country, but one common indicator is way less transaction volume. And of course, we in the pyramid map we look at the decompression at the yield levels, and we faced nearly in every logistics region in the Eurozone. Please have a look at the pyramid map for details of increasing yield levels. Starting in the middle of last year, there we had around 40 to 50 bips, in some cases even more, in some sub-markets a little bit less. But this continued in the first half year for 2023. And you see it on the right side with the biggest increases, especially in the Netherlands, where we first saw a big compression, and then with very low yield figures. So there was a big decompression to really go back to the way the investment markets were before the big compression cycles. We see it in the eastern parts of Europe, or in some cases of the German very high priced markets. When it comes to the overall figures, we see despite Germany, we see no markets where we see is 3 before the dot anymore. It's all about 4.5% until 4.7%. And of course, we have 130 submarkets. There's a bigger spread. So it's not like the risk levels. It was more or less the same before the change in the market determined in the middle of last year, and now we have a more a difference in the market again with core markets, with core plus markets, value add markets. So it's not one big type of market anymore, but with more differences again, like in the years before. When it comes to Germany as one of our biggest markets in the Eurozone, and of course, Garbe is coming from Germany as its home market, we wanted to share this information as well. Here we have a little bit lower yields in the top markets, Munich and Berlin, but then a pretty similar picture when it comes to the changes. And when we want to discuss about yields, we always ask the LinkedIn community, what do you see? And in the beginning of this year, we asked this, what do you see? What will happen to the initial yields for European logistics properties? And a third of the panel said they will fall again. This is even reduced in the August survey, and the share which say no, they will continue to rise or decompress, even a little bit increased. So the question, are we hitting the floor? Answered by the panel is not yet. But we have to discuss when it comes to what are the circumstances, where are the levels really made, where are they based on? It's more or less the stability of the market, the interest rates, and like I showed you, there are really signs of a better circumstances. But maybe the panel is still in a little bit in shock and do not see a big or a trend or a difference in the trends, but we have to look each month on the change of the figures behind it. So yeah, like I said, when does a window of opportunity open? We had to put or create an index value for the Euribor because it spiked so much that didn't fit anymore on the axis for the other figures. Well, there is easing of the tension when it comes to land prices, when it comes to construction costs. There's still increasing rent levels, and there could be a change in the EURIBOR, in the short-term financing framework. So a window of opportunity could open starting maybe in the third quarter this year, but only if you're not so much dependent for high debt, but have equity available because of the repricing of many really good opportunities of really good locations of properties with good tenant situation. So if you have equity on your available, it could open investment opportunities. But for most of the market where they use debt-oriented or debt-oriented players which use debts, it could happen when really the changing are kicking in, beginning maybe in the after the second quarter next year, or even the quarters thereafter. But like I said, one of the upside for the logistics market is that we have really low vacancy levels. There's really structural demand still. We have to keep a lookout, like I said, for the global economic dynamics. We're not blind to it as well. But still, there's a big increase because of the on the one time of the demand, low vacancy, and of course about the increase in construction and financing costs when it comes to new properties. We really needed, or the industry needed, higher rents to finance it, to keep the project development going. As you can see, there's still a big increase, and the biggest rental levels we see at the moment still in London or in markets which are not part of the Eurozone, but have really high priced markets, like for example Munich as well. And when it comes to Germany, like I said, one of our biggest markets with some of the biggest changes we saw. We saw changes from €1.10 in Cologne, for example, or in Dortmund, and this only between the last quarter of last year and after the second quarter of 2023. So really big increases we see. And we are seeing levels from €9 or €8 in the top 7 market, and this goes down to even the regional markets thereafter as well, like Dortmund, Nuremberg, or other markets. So really the rental levels we saw years before, around 3 to 5 euros, we won't find it anymore. And again, we asked the panel on LinkedIn, what do you feel? Will they increase or do you see they are falling again? The share in January was 60%, which saw that the rental levels were still increasing. This decreased as well, as you can see on the right side. Only 49% said it will continue, but this is only, like we interpret it, as because the rent levels are already very high in many markets, and we have to keep a lookout that our tenants are able to pay the rents, of course. So in some markets it's already a little bit problematic. Not in the top market when it comes to tier 2 or tier 3 markets, then it's a little bit expensive for many smaller companies. So now with a view on the facts and figures, I would like to hand over to Marco, or give back to Richard, so can may introduce Marco. Thank you very much for the attention so far, and happy to stay in the discussion or answer any question thereafter. And of course, you will get the PowerPoint presentation of the slides after the webinar. Thank you very much.
Great, thanks very much, Tobias. Really interesting, I think, there, and important to be able to see that survey, I think, over time, because that really gives some insights about how the market is changing. So that's fascinating to see that. And interestingly, I was at the EPRA conference yesterday, and a number of those elements in terms of what's expected around the ECB, but also short-term valuation falls. I think there was a sort of straw poll, which of course is not an exact poll, and it may reflect how the attendees at the EPRA conference were feeling, but I think it was 94% of people were expecting values to still drop in the short term. So very interesting to see that coming through as well. Marco, fascinating for me as well to be able to pick up a little bit on the Italian market, because it's not one we see so much about. So it'd be great for you to just give us some insights over what you're seeing there at the moment, Marco.
Yes, Richard, thank you very much, and thank you to Tobias for the very detailed and accurate market presentation at European level. And again, welcome to everyone is attending this webinar. I would say that the macro analysis that we see can be applied also to the Italian market. The effect of the rapidly increase of the interest rate and the construction cost, although the latter now are quite stable and we are seeing a slight downward trends, brought to a sharp reduction on the investment activity in the Italian market. If we see in this slide the evolution of the transaction on the volume in logistic and real estate in Italy, we saw for 10 years an uninterrupted growth until 2022. The data of 2021 is affected by a large M&A, and if we stripped out this large M&A, we will see that the figures are very similar to what we have in 2022. And of course, in the first half of 2023, we have a big drop with investment activity in the first 2 quarters of slightly above 50 million euro. But with a really important piece of information that we can maybe take in the next slide, as we can see, logistics was in Italy in the first half of 2023, and for the first time in its history, the asset class #1 in terms of investment in Italy. With the 38% of the total volume, it has surpassed office and more than double retail, that has been the king of the Italian market for over the last 15 years. And also, if we consider that logistic percentage on the total investment in Italy, an average in the last 10 years was about 16%. With the 38%, again, we have more than double this annual average. And if we consider last that on 10 years ago, logistic accounted 1% of the total investment in Italy, it shows how resilient is this asset class in the Italian market, even in this very difficult time. And if we come back and we see what is the forecast for the year 2023, we see that we should have, we expect to have 1.5 billion euros total investment in logistics, which is quite in line with what we had in the average of the last 10 years. And this is, I mean, there is some peculiarity of the Italian market for the reason why this asset class is more resilient than others. And first of all is a historical very low rent that we have compared to the rest of Europe, that linked to a higher yield that we historically have to the with the rest of Europe, led to a extremely low capital value. That is a downside protection for investors. If we think that in Italy, the average logistic value per square meter is around 1,000 euro, is probably less than the half of the northern country, where we have the same fundamentals in terms of building quality, ESG standard, and tenant ratings. So together with that, the slowdown in new developments that has been, of course, given not only by the increase of the interest rate and increase of the construction cost, but in Italy is also due to a lot of restriction that we now have on the land consumption by the main logistic region in Italy, that are the northern part, together with a historical lack of modern stock and high demand from logistic operators, brought the vacancy rate below the physiological rate of 2%. And also an increase of the rent much higher than inflation. Just to make an example, property built and let 1 year ago have now a potential upside in terms of rent of about 15–17%, while for the record, the inflation in August 2023 in Italy is 5.4, so more than 3 times. And this is led in a general decline of the investment market in Italy for all the asset class, a smaller contraction of logistics compared to the others, office and retailing lead, that have not benefiting, as also Tobias said before, of the mitigating effect of logistics, but they also facing structural difficulties and changing. So for that reason, we also believe that development operation that will be delivered in next years will benefit of a further increase of the rent, combined with what we expect could be a downward correction in yield that should follow the downward correction of the interest rate. Just to conclude this first brief statement on the Italian market, is too early probably to say whether logistics will be the queen of the Italian market for 2023, but we can certainly say that even in Italy, logistics is a stable, attractive for investors, and above all, resilient asset class. And I can leave to you, Richard, and to my colleague Peter for the following.
Great. Thanks very much, Marco. Very interesting to see there. You mentioned the fact that it had only been 1%. And was now the sort of top asset class just over a period of 10 years. Is quite extraordinary, really. And a lot of focus actually around the Italian market at the moment, which is interesting to see. So very interesting to pick that up. And I think the timing in the market, you know, there's a lot of discussion about when to invest, whether to wait and see, what are the opportunities. And interesting, you mentioned there that there may be a development play here as we move into a lower rent, you know, a higher rental situation in the coming couple of years. So it'd be interesting, Peter, just to pick up with you. Obviously, you're there, head of fund management and capital markets. So it'd be interesting to get your take, I guess, on that in terms of timing into the market. I suppose where you're seeing opportunities, and I guess where you're seeing the opportunities in terms of timing into the market as well.
Yes, so thank you. Do we see the slides now?
Perfect.
So, okay, so actually just what you see now is a bit the Garbe map where we are, and I will start just a bit light with a tour around Europe, excluding Italy, to give you some views in how we see it. And the next slide, I will come back a bit to the main question: is the right time to go in, or should we wait? I mean, it's the most interesting discussion we're having these days, and actually we'll have an expo in a couple of weeks. So if you look at the map, we're active in the UK. UK is a bit for us a special market. It's still, let's say, post-Brexit, so they have a bit of their own economy regarding logistics. On the one side, it has the highest interest rates for developments, which are roughly at 9% now. On the other side, biggest rental growth, especially in the area of London. So it's still attractive. As I said before, investment markets will be touched, let's say, on the next slide. Germany, I mean, without a doubt, we're active here. We're active as a developer. We have a slightly increased vacancy rate, but still in and around historical low 3%. We have done our biggest signed the biggest lease agreements in the automotive sector this year. Coming back to, let's say, 1.5 years ago, everybody thought it was dead. Yeah, now it's, I think, more than 80,000 with Porsche and roughly 75,000 with Volkswagen. So you see that's almost, let's say, a bit of shift on that. Netherlands is, let's say, just one logistic hub. Anyhow, on the investment market, you see, let's say, a rapid increase in yields, not driven by the Netherlands itself, the economy, but just by the real estate transfer tax system in Italy, where you don't have to pay anything if you sell the assets in a 6 months' time. If you keep it, you have to pay 10%. And this is a bit where we see now, especially those developers who just, let's say, hand over the premises to the tenants Now the 10% clock is ticking. This is a bit, let's say, the situation we're facing in the Netherlands, and that might be a bit special because we have, let's say, historically they were in and around the German level, and now they're I wouldn't say far below, but they are below. So, but this is, I think, from my point of view, more driven by the real estate transfer tax system in Italy. Spain is still some two active regions, Barcelona, Madrid. Total different in Barcelona. You have to have the plot, and then you're the lucky one. In Madrid, there's, let's say, more land than in Barcelona. So there is the idea how to bring a tenant in is a bit more the question mark, because you have to do all the urban works up front. So there is not, as we have in Germany, for example, 15 to 18 months development timing. It's much longer, and the uncertainty how long the tenant demand is there, where it is some kind of extra layer. In Spain, France, still there's a Paris region, so it's fine. Italy, Marco did it, and if I look at Eastern Europe, it's amazingly robust. If you look at Czech Republic and Slovakia, almost no vacancy. The advantage of these countries is that very close to the border to Austria and Germany, massive lower labor work, and they're starting, let's say, to establish their own internal capital market. So we have a couple of local investors coming out of these countries looking at our developments for long-term hold, which we haven't seen in the past. Poland will grow without a doubt. Poland, I think, from our perspective, the only, in brackets, country where you don't have any scarcity of land. So the availability of plots for logistics is massive, which is like a bit positive on the tenant side. Looking from an investor's point of view, it's slightly different than the others. So going to the next slide. So this is a bit, let's say, the headlines which Tobias mentioned. So I'm still happy to be in the logistics industry. Yeah, okay, real estate is overall, since, let's say, 12 months, 8 months, not really on the winning side, but logistics still on top of it. It's the fundamentals. The fundamentals, the demand from the tenants are still there, and we don't see any change for, let's say, the next 12, 15, 24 months. It's driven by the e-commerce in markets like Italy, Spain, Eastern Europe, where you don't have the absorption rates what we see in the UK. It's driven by, in the UK, by the post-Brexit. It's driven by, especially in Germany, the fundamental shift from train during COVID back again to the trucks. It's driven by the automotive sector, is coming from the traditional sector now to electricity. So it's a lot of things going on. You have a lot of former logistics sheds who are a bit more in urban areas who are now used, let's say, for residential or whatever, and be transferred. So therefore, we don't see, let's say, anything which is there, which could, let's say, break the demand in the near future. And thus you have the increased rent. What we see on the investment market, we as Garbe were in the past on the top 3 developments and top 3 investment. If you look at the number, if you look at our numbers this year, it's a bit like the market. It's not nothing, but comparing to what is in the previous years, almost nothing. The reason is if I look at, let's say, the typical German investors, pension funds, insurance, they stopped investing in real estate. There's a lot to do with the diminution effect. So the liquid assets are going massively down. So the ratio for real estate is too high. This is the one thing. And secondly, a lot of them are looking, let's say, at a 4% income rate, which they could get on the bond market. They just have to produce your 4%. They're looking at the nominal value. Yeah, they don't care that despite the typical bond logistic real estate is inflation hedged, so they don't need it. And this is, let's say, is a mixture was brought, let's say, the typical investment market for core plus buyers down to where we see. On the other hand, and this is the interesting part, all, let's say, the big opportunistic investors coming from the US, a lot of those with an A or B in the beginning of the name are investing heavily in logistic developments now. From my perspective, because they're doing now the deals and they're selling it in 2 or 3 or 4 years' time to the ones who are not on the market. So therefore, coming back, let's say, to a main question, is it the right point to entry from my perspective? Yes, without any doubt on the direct development value add side. And on the other hand, even, let's say, on the standing asset side, from my point of view, because we have brought the prices down, the gap between development yield and exit yield is so close. Still okay for the developer to make profit, but far away from what we have. And therefore, I don't think that the developers who are producing it will sell it on a lower price than you can get today, because they can keep it. They don't have to sell it. Yeah, you can refinance it. Financing is once it's leased out is doable. So therefore, I think now it's the right timing. As I said before, the big especially those from the US are investing heavily, and the others I think will follow. Thank you very much.
Perfect. Thanks very much, Peter. Really interesting. And there was a note in the chat as well asking whether or not the slides will be distributed to everybody. Thanks very much for that, Darren. And the answer to that is yes. They will be sent to everybody. They'll be available both on our site, also I'm sure on the Garbe site, but we'll also make sure that a link goes round to everybody who registered for the event, so that you've got access to those slides as well. And if there are colleagues who weren't able to join this one, we will also make the video of this available on demand as well, so that people can also connect and benefit from this afterwards. It will be interesting maybe just to pick up on a couple of those points. Maybe just starting with you, Tobias. I mean, you mentioned that core markets there were a much bigger focus. What does that mean, I suppose, in terms of the locations? Do you see that as something that is going to be a trend for the rest of this year and going into next year in terms of that focus?
Yeah, very good question, Richard. I'd like to answer it this way. Many investors tend in circumstances, in environments which are maybe a little bit risky or not, it's distressed. They say, okay, we go back to the locations we know we are happy with. We know there's economic strength, there's demand, and everything which is a little bit outside of the usual. It is maybe we want to skip for the moment and say, okay, not the right time for it. On the other hand, when it comes to availability of what is important for logistics, we see a big trend outside of the core markets, because in many countries in the Eurozone, there's this, we heard it despite Poland and some other countries, but in the major markets, we have a scarcity of lands, we have a scarcity of workforce, and in the biggest logistics regions, and we have a very high-priced situation when it comes to plots of lands as well as workforce. So our tenants, and this is what we can see in different studies or different white papers, they tend to move outside of the logistics region of the biggest regions, and are very happy with availability of the plots of lands, bigger chunks, and of course with the workforce. So, for example, tenants who are happy to rent in the Munich region, it's a really a great region, but they really had problems finding suitable sizes of plots of lands suitable amounts of reasonably priced workforce. So they were happy to move, for example, to the eastern part of Germany when it near Leipzig or whatever. And similar situations we saw in different countries as well. So it's really a difference between, are we looking at the transaction market on the transaction side of the logistics real estate, or the tenant, the demand side? So this is, I don't know, Marco, if you can you see this trend as well in Italy? Maybe you can amend or comment on it.
Yes, absolutely. Totally agree. I mean, as we said, also we have this big issue on the scarcity of lands in Italy, and due to the fact that we have to switch at the end to the brownfield from greenfield, the tenants are looking for a new location that allow them to be well connected, but location that were not until a couple of years ago on the rear radar of the developer. And so that was really important. As I said, we have a very, very low vacancy rate, and this very low, well before below 2%, is mainly due to B and C grade buildings. On the modern one, on the grade A, everything is let and also pre-let when it's built. This is because the demand is much higher than the potential availability that we have. So basically, everything that is now in location that can be well connected, even if we're not the historical prime, are very interesting for the tenants. What we are seeing also in Italy, but usually this is, you know, Italy has two speeds, it's two countries in one. So what we are seeing is that finally also the south is improving and is in the radar of all the tenants. From tenant side, there is a huge request from tenants from in the area from Rome to Naples to Bari, that are the three main cities in the south. We don't have to forget that we have about 25 million inhabitants there during winter and 50 million during summer. And there is a big lack of modern asset, and for that reason, a lot of new routes are explored by the tenants. So the south is the new one. Of course, as usually in Italy, the south will arrive 10 years later than the north. That's it's the story of our country, not only for the logistics, but in general for the economy.
And Marco, I just wanted to pick up a little bit on that in terms of the locations there in Italy. Obviously, previously, a lot of discussion around, you know, things like the new Silk Road and train transportation coming across from China, but across Russia, obviously into Europe, which is no longer a viable area, really. So is that driving, I guess, more shipping routes? And does that mean that potentially there's a benefit for Italy, and particularly maybe southern Italy as well, in terms of those being a route into Europe, which may have come via a different route previously?
Absolutely, Richard. That's a good question, and this is the part of we have these new European bonds, of which Italy is benefiting more than other countries at the end in terms of billion euros, and a big part of the project are linked to the Italian port in the south. In Sicily, in Calabria, in Puglia, and Campania region, and this is because then we can create from a new route from the sea, and then from the sea to connect to the existing infrastructure on the autoroute to connect to the rest of Europe. But that's absolutely one of the main points. As usual, all this project has a long story, so it's difficult to see the result in a very short time frame, but absolutely that's true.
Great. I've got a couple of questions coming in, and I'll pick those up in a second. But Peter, I just wanted to come to you. You mentioned there about kind of the capital flows and the appetite for capital coming into the logistics space at the moment. Do you see a difference between German capital, especially, for example, and other European capital, or potentially North American capital, for example? Are there differences in terms of the appetite there?
Yeah, definitely. It's Northern American capital, which is by far the greatest part, by far.
Okay, great. Let me just pick up on a couple of the questions that have come in, and thanks Darren and Alex for these. So let's start with, so we've got there's a scarcity of available financing at present, which of course we're all familiar with. How detrimental is this on new development, but also the refinancing of existing schemes? So that's one that we can pick up on. And there's also looking at the second tier locations gaining in importance. How will the shift impact the primary location markets in Europe, and what might be the implications for investors? So I don't know if anybody wants to pick up either of those 2 points.
Maybe I start with the financing. So yes and no. So we still get financing for speculative real estate or logistics developments in every European country. There are a couple of lenders who in the past did it, who are out. So the offer or the interest on the lending side, if just let's say in the past maybe we get 8, now maybe 3. Yes, but it's still possible. So we will get it. Margins are going a bit up. Therefore, it's possible. It's doable. We're getting, let's say, unbinding term sheets before starting the construction. This is a bit what we are looking for. It's possible. It's more expensive. Yes, no surprise. We have, let's say, the highest level, as I mentioned before, in the UK, was almost roughly 9%, which is massively. But having in mind that a logistic development takes, let's say, 15 months, it's okay. Interestingly, if it's leased out, I wouldn't say it's a non-issue, yeah, but it's no problem at all. And even on the standing asset sides, it's possible, and still you get, let's say, for the development loan, 60% LTC, and then you convert it into a typical 50% LTV loan afterwards, and you can pay, let's say, the interest on the standing asset out of the money which the tenant is paying. So this works still.
Okay, great, really interesting. Thanks for that, Peter. And yeah, there's a lot of focus. I mean, it'd be interesting to see as well whether Garbe is, and I think we'll begin to learn this over the next months, actually, whether companies like Garbe are in a slightly better position than others when it comes to financing and refinancing. Did anybody want to pick up the secondary locations side of that, second tier gaining more importance, and will that shift to an impact on primary locations in Europe?
Yeah, I'll pick this up, and maybe the other ones step in if they need to feel that they have to amend something. Well, in addition to what we said earlier, the core locations or the well-known locations, it's not meant that they are facing the danger of not being sought after anymore. It's really because the available space is so low. We really have to see the major focus of the take-up of the activity in the last decade was concentrated on those regions. So, and together with the demand for other asset classes, residential or whatever, it was really a competition of who gets the plots of lands, and industrial logistics sites. We're not really the ones in favor of the local policy. So it was really difficult to get a building permit, to get a new lands being from the local community to being suitable for logistics or industrial assets. Now, industrial, it's better because they approve more workplaces, the tax outcome for the community, of course, but for logistics assets, it was difficult. So having this in mind, the tenants really said, okay, connectivity, or it's a set of a framework which really is over 100 years old. you need I don't know the exact translation, but it's plots of lands, it's workforce, and it's capital. Capital is not bound to any location, but it's really land and workforce and connectivity for when it comes to logistics. And this can be found in other places as well. So as long as these framework can be applied to a location, the tenants are really happy, and this is new. The investors really need to soak in this knowledge that those locations are not risky or whatever, but it doesn't mean that the core locations are facing danger of not being attractive for tenants or whatever anymore. It's just they cannot provide more possibilities, more chances. So it's another set of location which it's not about the top 7 markets in Germany. It's about the top 28, 29 locations, which are really and even in the room, in the space between, for example, if it comes to Germany, between Hamburg, Hanover, and Bremen, there's a little bit of space between along the motorways, the axis connecting those regions, and there's really high activity compared to the last 5 years. So the tenants are happy, and therefore these locations will stay in favor of the tenants, because plots of lands they won't get. It's not like an apple on a tree which will grow anew. It's there or it's not there. They won't increase in availability in the near future.
Great, thanks very much. Another quick question that's coming, and if anybody's got a view on that as well.
Yeah, I mean, maybe a few words regarding Italy. Just Richard, concerning financing, I can confirm what already Peter said. This apply the same for Italy. We still have the possibility to get financing for developments, speculative developments. Of course, in Italy, that is again historical. We have a lower LTC, so we are now having a LTC that is probably in a region of 45-47%. But this can be increased up to 60% if the asset is leased out during the construction. So again, we can reach the level which is similar to other countries. And also for what Tobias said, we don't think that the historical core location will suffer from the new core location that's going on, because the scarcity of land, and there is a scarcity of product. If the new location has good connectivity and good fundamentals, they can become new core location next to the older and historical core location.
Great. Just a quick reminder as well that there's around 8 minutes, 7.5 minutes left now. So if you've got a burning question, now is the time to put it in. There's a couple of questions in there that I'm going to come to in the chat. But if you've got one, don't wait for another 5 minutes because it'll be missed. So put one in if you've got a chance to do that. And Alex, thanks for this. Quick question as well from Alex around family offices, whether they're visible at the moment in terms of real estate financing. So interesting if anybody's got any take on that. But also Alex is asking, in the light of the recent trends where family offices are significantly steering their capital allocations towards asset diversification, do you perceive a strategic pivot towards industrial real estate assets? And if so, how might that shape the broader investment landscape in the coming years? So it'd be interesting to see if anybody's got a view on that. I mean, obviously there's been quite a focus in terms of logistics and industrial real estate, and it's interesting to see Alex picking up that family offices are potentially moving more in that direction. I don't know if anybody else is seeing that.
Definitely yes. So I mean, we as Garbe, I mean, we are some kind of a family offices. We're a joint venture between Garbe and Nixdorf, so therefore we're maybe a bit part of it. For us in the past, let's say there was, let's say, almost no contact to other family offices. Might be because it was not necessary, because we have the typical core investors. Now they are there. They are looking at logistics, which from my perspective was not on top of the list in the past. Real estate still is, and now we see it. But other than you maybe mentioned, not on the financing side, more on the direct equity side.
Okay, great. I wanted just to pick up a little bit on the nearshoring trend as well, Peter, because you talked about automotive coming back, and I think that's interesting because there has been much more of a focus on automotive, battery plants, a whole series of different things coming to that. Are you seeing much more of a driver, and this can be to anybody as well, but first of all to you, Peter, in terms of that nearshoring trend and I guess more of the production side being placed back into Europe?
I will try to answer the first half of the question and then pass it over to Tobias, because this is an issue we always discuss back and forth. Yeah. So I mean, what some kind of a nearshoring, reshoring trend was, let's say, the system of the logistic changed a bit from just in time to just in case. So this is, let's say, part of my personal interpretation of the nearshoring. What is really visible? The other is a bit like we're discussing it. We believe, we think it's there, but it's very, very difficult, let's say, really to measure it and to find it. It will be a driver. It will be a driver on both ends, and then I'll pass it over to Tobias. I mean, nobody would decide now to go, let's say, to Eastern Europe if it's beyond Poland, which, let's say, in the past might be a bit either. So they're staying here. This is, let's say, but we can't calculate it. And now I hand over to Tobias, who did a lot of work to try to find out in square meters and numbers, which I'm asking for on a daily basis, to be honest.
Yeah, we can continue that internal discussion during the webinar. Excellent.
I just wanted to say, Richard, we can make another webinar about this topic, because this we did a research piece on it during the pandemic, when it was really the high time of supply chain disruption. I think globalization did not come to an end, and this is not the end of globalization, but it will change the global flows of goods, and we saw it a few weeks ago when the BRICS community opened their arms to welcome new land, and when the G20 convention will be opened in the near future. There are two major countries missing, of course. One, because the leader is facing danger of going to jail, and the other one is not participating, China, and he's sending the second in command, or not. And this is part of the huge discussion. Do we see a decoupling of markets? Do we see a block building? And this is a really huge discussion about geopolitics and whatever, but it will impact how we produce goods and send goods to the customers, to the ends. I think, not necessarily speaking for Germany, but for the Eurozone as a whole, there lies a big chance, because being dependent on certain providers of goods, and for, let's say, chips or other devices similar to it, showed the industry that it's risky. And in the companies for decades, the ones at the steering wheels were the cost cutters. They said, "Oh, it's too expensive. We move our production to Asia." And now, in some instances, the strategists were on board and say, "Okay, wait a minute. We saw plants not being able to produce goods because we didn't have any parts available. So we need to think about it. We need to be ready when it comes again back to the situation." So there was a part of a stockpiling and buffer warehouses built up. And at the moment, we see they are being emptied, because liquidity is again important. And we can't really see it. We can't really measure it at the moment. If the Ukraine war didn't happen, then I think it might be a more clearer picture on this. But at the moment, it's all a little bit foggy and hidden behind the big issues. But I think what is happening is that production and flowing of goods is not dependent on one source. It's broadened, not necessarily in Germany, but for example, production in different Asian countries, maybe even in Europe, not in the most expensive market, in the market where the most or the workforce is so scarce when it comes to high skilled labor, especially. So when it comes back, it's more like CEE markets. At the moment, we heard it's not so for the investors, not the most sought of markets, but for the relocation, the eastern parts of Europe could provide very interesting. The northern part of Italy as a whole can provide can be very interesting, or the south of Europe in general. We see, for example, Portugal is developing very interesting when it comes to certain industries. We heard a lot that the north of Africa is very interesting for relocation. This is true when it comes to availability of workforce and costs, of course, but it's politically speaking very unstable. So when it really comes to relocation, then often the more stable markets, the cheaper, but the more stable markets could be interesting, but we see it in Germany and other markets as well. Battery plants, chip plants, and other kinds of industry are being relocated, and even in Germany. I don't have the exact numbers, but by the end of this decade, a huge share of the battery production for cars, etc., will be located in Germany. And the industry for the chip fabs will be scattered around Europe because they see the necessity to reduce the risks involved. Oh, and I see we're already past 12, so I come to an end. So it's not a very clear picture. We monitor this a lot, but at the moment it's not a clear answer to this yes or no.
That's great. Thanks, Tobias. And there is one final thing that I'll have to ask everybody, because I already agreed to in the chat. I agreed to ask it to everybody, which is if Garbe had, not yourselves personally, I guess, a cool 100 million to play with, where would you invest? Country, region, type of asset, what would be your top pick? So you've each got about 15 seconds on that. So I guess, where do you see the biggest opportunity?
When it comes to real estate, I still think logistics is really interesting still. When it comes to location, I won't decide, because otherwise we'll get phone calls from the other countries and say, oh, what are you saying? I think many countries are very interesting. That's why we put up a foothold in every European country and say, this is attractive. Like Italy, for example. Marco, handing over to you.
Yeah, thank you, Tobias. I wouldn't say Italy because, but I should say 100% Italy, like 60% development, 40% core. But I would keep probably this share, and without speaking about my country, that I really believe on what I said. I think that I could keep this share, because the developments can lead in 2-3 years to very good results if interest rate will fall down and yield will go down a little bit together with the increase of the rent. And on the core side, this is probably the best moment to buy with good net initial yield, that probably if we'll be back, not probably at the peak of 2021, but in the half of that is a good cash on cash for the investors.
Great. And Peter, if you had to
finally, it's me. Yeah. So I would put, let's say, 50% in developments in those countries where we're active. And this is not a theoretical question. We're doing it. So we're using own balance sheet to do it. I would go for, let's say, 25% in one of our funds, who is, let's say, fresh and can do developments besides, let's say, the standing asset they have in a portion of 25%. And the remaining, I would just keep for end of this year and look what happened.
Great. Thanks very much, Peter. Really interesting discussion there. We covered a lot of ground. Fascinating to see that research again, especially with the the comparisons over years. So that's a really interesting topic. Just a reminder to anybody who may not know that there is another session as part of the sort of Garbe Live series that we're doing, which is going to be focused on the CEE markets, but specifically the CE3, and in that case we're looking at Czech Republic, Poland and Slovakia. And that's on September the 13th. So, and there is, I can see that Frank has put a link in the chat to that. So do register for that and join us for that one. Thanks very much, Tobias. Thank you, Marco. Thank you, Peter. Thank you to everybody for joining us and also for your questions. Great to be able to pick those up and share them. And if you're watching online, thanks very much for watching. Thanks very much, everybody.
Thank you.
Thank you. Thank you. Bye.
Bye.